get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Welcome to the Financial Purpose Podcast. We are hot in the middle of summer. This is episode 46. Welcome to the show. Glad you're here. Today I'm going to talk about financial planning and specifically the approach that we use at lifemoveswealth.com. The reason why I want to talk about this is because we're in the middle of the year already, and you may not be paying much attention to where you are financially, certainly not as much as you probably will. Maybe as you're heading into the end of the year and you're thinking about, how much money can you spend for the holidays, or maybe at the beginning of the year where you're thinking about what the tax return might look like and how much money you need to have set aside for paying the taxes or whatever. But this is, I think, an important topic because effective financial planning is certainly essential to understanding where you are financially. Every single thing that we do as adults, they didn't tell us this, by the way, when we were kids, because we were all so excited to become adults and we just couldn't wait till we could just do our own thing and make our own money and do whatever we want to do. What they didn't tell us is that being an adult, every single decision we make has a financial impact. And if you're not in tune with where that financial impact is and what it's doing to everything else in your financial life, that can be very problematic. And so there are, when we talk about financial planning, some traditional approaches that use things like Monte Carlo simulators and time value of money calculations and things like that, long-term projections. And those things can provide some valuable insights, but they don't typically, in my experience as a planner, they don't typically provide really good guidance on the dynamic changes that happen in your financial life. And what I found is that the longer that we do financial planning and the longer that we run projections, so if we're looking at a decision you want to make today and we're putting it across what is this going to look like in 30 years based on what you need for retirement, the challenge we have is accounting for all of the things that may change in your life, because I don't know where things are going to be 30 years from now. You don't know where things are going to be 30 years from now. And if you're from the future, I want to have a conversation with you about some other things because we can make some money together. You know what I mean? But anyway, for the most part, we don't know. We don't know what taxes are going to look like. We don't know what your income is going to look like. We don't know how many times you're going to buy and sell a piece of real estate. We don't know if you're going to lose your job, go into business, send a kid to college, inherit money. We have no idea what all that's going to look like. So at Life Moves Wealth Management, we use the Elements financial planning tool. And this particular challenge is where Elements totally shines because it offers a comprehensive and totally adaptive approach to financial planning based on what's happening in your life today and maybe tomorrow and maybe a year or two from now. And so with Elements, we're able, from a financial planning standpoint, to recognize that financial situations do not remain the same. They change from day to day, almost literally as soon as we have this conversation. 5 minutes later, your financial situation is going to change, and maybe tomorrow it's going to change again because you will have spent money, or you would have received money, or your investment accounts would have earned money, or your investment accounts would have lost money, or whatever. And so your financial situation is not static. And so Elements helps us recognize that. It's accurate, it's up to date, it gives us a better picture of what's happening in the now in your family's financial standing. So rather than relying on those long-term projections, we simply monitor the ongoing financial progress of our clients, and it helps us do a lot of great things. It helps us have a lot of really good conversations, better conversations about things like, should we purchase this house? Should we purchase this car? Should we lease this car? Should we sell this investment? Should we buy this investment? Should I change jobs? Should I be a stay-at-home parent for a while? How can I, whatever that conversation is, we're able to have better and richer conversations because everything is up to date and it's current and it's looking at now impacts, and we can project longer-term impacts if we want. but this gives us the better tools to do it. So, because we're midway through the year, um, I started thinking about this because last week was when I sent out all the proactive reports to clients of Life Moves Wealth. So every month they get a proactive update on one key area of their financial life. And so they always know what's going on. They get, here's what your percentage is, here's what I see, here's what I know about your situation, here's what we need to do to update. Hey, let's have a conversation about this because this looks a little different than the last time we looked at it, or everything's right on track, everything's looking really good. See you in a couple weeks, couple months, whatever that may be. They hear that proactively from their financial advisor, and it helps them understand where they are. They also have a great app that they can get into, and at just on demand, again, with regular, updated in real time, they can see exactly what's going on. And the longer that we do our work together through Elements, the more the clients can look at that and understand exactly what they're looking at. So that's the goal. And so with all that said, today I want to actually walk you through the financial planning approach that we use at Life Moves Wealth Management with the Elements tool, why I think it's important, and how our clients get a lot of value from that. And to do it, we're going to look at the financial planning profile of our clients, Sam and Sally. Now, of course, Sam and Sally, this is a made-up situation, but I keep track of it. We go in and we update numbers, and we use this as an example client, so that way we can walk somebody who's considering hiring us through what a sample financial plan will look like, and hopefully, even better, is we're able to walk them through their own financial situation based on the information that they've put into Elements. But I want to show you kind of what all of this means and how it breaks down. And for the listeners, I'm going to do my best to explain it. If you're watching this episode, then you'll see this on your screen. But just as a brief overview of who Sam and Sally are, so you can kind of get an idea of the kind of people we're talking about here. These are just kind of, average people. They're probably your neighbors. Sam's employed as an operations manager for a small tool and die company. Sally owns an architecture firm. They have 2 children. Their daughter, Samantha, is already in college. She's about 21 years old. She's on a soccer scholarship playing at her state school, and she is studying biochemistry. And they have a son who we call Sarge, and he just graduated high school. He is going to college to study marine biology, so he's headed down to a coastal school out of state, and he is a baseball player. He's currently walking on to play on the team. He's hoping to get a scholarship. Their household income is about $280,000 a year. Sam recently applied for a promotion. If he gets the promotion, it should come with about a $20,000 raise. So their income and financial situation will change just a little bit. But with that, context there, the other thing to note is that they spend somewhere about $162,000 a year, which is a little over $13,000 per month. At their income level, that's not that unusual. Things are just more expensive. You just spend more money. You do more things when there's more income, and so that's where they are. Otherwise, they have a total net worth of about $3.2 million, which includes a lot of that includes Sally's business, which we'll talk about here in a little bit. So to kind of help us get started, I'm going to walk you through each of the rows of this is the financial scorecard is what you're seeing on the screen. And every client of Life Moves Wealth Management who is engaged in ongoing financial planning sees a scorecard that's like this, and everybody's is a little bit different. So the top row that you're going to see has 2 financial indicator tiles, and we consider that to be the risk profile row. The first thing you're going to see there is an E and an R. That stands for equity rate. And so what that means is it's basically based on how your individual accounts are invested. That's going to tell us in the aggregate how much of your total financial investments, your marketable investments, your investable assets, right? What's in a retirement account, what's in a brokerage account, whatever it is, if it's invested, how much of that is exposed to stock market risk. And in their case, 63% of their investable assets are exposed to stock market risk. Now, that is squarely what I would consider to be a moderate investor. And again, that's a blended rate. And just for some context, at Life Moves Wealth Management, if we're managing the investments, a moderate investor is probably going to have somewhere in the neighborhood of the low 60s, maybe 62, 63%, all the way up to about 75% of their investable assets will have stock market exposure. And we do that because that's the best place over the longest period of time to get the most growth, the most stability. We do have volatility in the markets and we manage that, but it really is the best way to continue to grow wealth over time when it's done properly. And I would say for Sam and Sally, based on their ages, Sam is 48, Sally is 49. And with them, having a 63% rate of equity is comfortable. That's a good run based on their risk tolerance. Maybe we dial that up a little bit based on what's happening in their 401ks or their brokerage accounts, or maybe we change the allocation. But for the most part, I think that's okay. And at the beginning of the client relationship, we would have assessed their risk tolerance anyway, and so they were squarely moderate, and so we may be a little underallocated here, but that would be a planning opportunity as we go throughout the year. The next box you're going to see is a light blue box, and it's IR, which stands for insurance rate. Now, this number we see all over the board for different clients based on what's happening in their financial life and their income and their debts and all of that. When we look at your insurance rate specifically, we're focused on life insurance, disability insurance, and liability insurance. That's typically what we're tracking here. We can also bring in things like long-term care risk. We can bring in property casualty risk, home and auto insurance. We can bring in business risk. We can bring in, errors and emissions risk, things like that. But for the most part, we're focused on where do they have financial exposure if something goes wrong in the bigger areas. And so based on Sam and Sally, just to give you an idea, they both have a $1 million term policy. Sam has an additional $50,000 of group insurance through his work, and Sally has $2 million of key person insurance that's owned by her architecture firm. So neither of them have any disability insurance, which can be a planning opportunity, but sometimes for some clients, we're going to assess what's the risk of injury at their work, what's the risk of injury in their lifestyle, and then determine what's going to make sense for disability insurance. A lot of smaller businesses don't offer great disability insurance, and self-employed people typically don't have it. And so that's a risk exposure that we just want to know and manage and then figure out what's going to be most sensible for them. You also may want to know that Sally has about $3 million of business liability coverage. Based on their net worth outside of the business, they have about a $2 million personal umbrella liability policy that just covers them if something happens on their property, if somebody's injured or if they get sued or something like that. So for the insurance rate, we're not targeting 100% here most of the time. And so the ongoing conversations around the insurance rate is just going to be to understand, do we have enough insurance based on what that insurance is supposed to do? Meaning, is it supposed to replace income? If so, for who and for how many years after the loss of the spouse? Is it going to fund college? Is it going to serve some other purpose? And if it is, we want to understand why insurance is being used for that purpose and what the best way to structure that coverage might be based on what those needs are. And again, at their ages approaching 50, we probably want to get fairly set on the insurance coverage very soon, because the higher premiums and higher rates come with the older that you get. And so once you cross that 50-ish mark, that life insurance becomes a bit more expensive, and so we want to make sure that we're on top of that. The middle row that you see now, there's 4 indicator tiles, and so that's going to be your cash flow row. For this row, ideally, we would want all 4 of them to add up to 100, but it's not always perfect because we know things like your spending is going to fluctuate, and sometimes even with the tax rate, we're looking at the prior year tax return, which may or may not reflect how close it's going to be for the current year tax result. And so we know that's going to fluctuate. Like I said, 100 is about what that should add up to, but it's probably going to vary a percentage or two either direction. So the first one that you're going to see is a kind of a grayish blue color, and that's going to be your savings rate. The savings rate is the total dollar of annual, what we would call systematic or planned savings or regular savings or scheduled savings or contributions to retirement accounts, right? Things that are set in place as a savings. And we're going to divide that by your annual income, and that's going to tell us how much of your financial resources, your income, are being saved for later purposes. Now, the thing with savings, if you go back a couple of episodes when I had Karen Moon on the podcast, we talked about the fact that savings accounts are actually better if they're labeled as future spending accounts, because anything that's being saved at some point will be used or consumed. And so we want to understand how healthy your savings rate is. And so they're at 14%, which is very healthy. Anything above 10% is in great shape. Anything above 15% is excellent. You have a lot of cash flow availability and you're using it wisely so you can save more. Once we get to about 20% or higher on the savings rate, then as a financial planner, I'm going to tell you that your financial outcomes are going to be pretty darn good because you're able to put away more money than you're spending. And that's ideal for anybody. So for Sam and Sally, for their savings rate, the opportunity here is going to be the opportunity will be to discuss their cash flow and see if they have room to do things like increase their 401k contributions or maybe to add additional money to their brokerage account on a regular basis. The brokerage account in their cases, they're only after-tax savings. They don't have Roth IRAs. Their income level puts them above the Roth IRA contribution limit. And so there may be some other options that we can look at, but the 401k for them might be the easiest place to dial up the contributions and therefore increase their savings percentage. Now, the second tile is a little bit of a purple tile, and that's going to be your burn rate, which is basically what you're spending. And so speaking of cash flow, the burn rate is how much you are spending less your debt payments. And that's on an annual basis. And of course, that's divided by annual income. So one more time, because I think I said that in a way that was kind of confusing. So we're going to take your total spending, subtract your debt payments over the course of a year, and then divide that by your annual income. Sam and Sally have a burn rate of about 41%, which is still within the normal range for their situation. Now, that number does move around based on what's happening in your financial life. So a good example is for my retired clients, their burn rates are significantly higher, but that's to be expected because they have retirement income. They're probably spending pretty close to their retirement income, so we're going to see a higher burn rate. They often tend to have lower debt rates, and so most of the money is just being spent on basic lifestyle because the income's lower, the percentage goes higher. So again, depending on what's happening, we have some flexibility there. The burn rate is the hardest number to nail down because spending is not constant and it tends to fluctuate month over month for most people. And so as you might expect, spending can sometimes become an area of opportunity for people to really look at and really decide how much they're spending. For the month of June, in fact, the update that clients received was on their burn rate. And I did have a couple of clients who wrote back and said, you know what, we ought to look at this again. We feel like we're spending too much money. So, in our next planning meeting, let's take a look at this and maybe you can help us figure out where we can maybe cut back or do some things differently or restructure some things. I had a couple of clients write back and say, this is great. We've been working on this for a while. We feel good about it. So again, the key there is they're getting a proactive touch and they know what's going on. Okay, next box over is going to be a green box. That's kind of like a forest green. That's your debt rate. Sam and Sally are at 17%, which is very, very much within the normal range. And for them, their only debt is they have their home mortgage. They have a business mortgage, which Sally, as the owner of her business, has a personal guarantee on. They have 2 car loans that are in good shape. And that's it, other than a small business credit card that usually gets paid off at the end of every month anyway, and so that doesn't really factor into the debt rate overall. Um, Anytime that I'm reviewing debt rate with a new client, I'm going to look at every single piece of debt, every single loan, what their interest rates are, what their payment terms are, how long they've been paying on those. I want to see how that loan is put together. And then I want to look at it in the aggregate with all of the debt combined, because I want to understand, first of all, what is your cost of debt, right? To carry all of that, what's the cost of that capital? And once I know that, then we can take a look and see if it makes sense to do any restructuring on things like mortgage notes or student loans, or if there's an ugly car loan, or if you have a lease coming up and we have a decision to make there on whether or not you buy out the car at the residual rate, or if you start another lease. I mean, there's all sorts of debt things like that that we're going to take a look at. Business debt absolutely is prime for considering restructuring, because there's just all sorts of things that happen there. And so, debt rate, that's definitely one of those things that really can either be managed well, or it can really be a killer. Restructuring that sometimes can help. Sometimes I'm going to take a look at what's available. Maybe we need to pay off smaller balances or higher rate balances, or there may be some other things there around the debt that we need to do. But we're always going to take a look at it, and that's always an important part of our conversation. And for our clients of Life Moves Wealth, the debt rate's going to be what they'll see in July. They'll get an update on that. Okay. Now, the final thing on the middle row there is your tax rate. TR is what you'll see. This one's very straightforward. I review tax returns every year, and what I do in there is I go through the 1040 form. I find, after all your deductions, how much federal tax did you pay, divided by how much income you earned, and then we put that in there. And then same thing for your state return. How much tax did you pay to the state divided by your income? And so once I know what you have there, you're going to have a tax rate. That tax rate, by the way, is considered your effective tax rate, because it's how much taxes you paid after all of your deductions and credits. It's not the marginal rate at which you pay taxes. And remember, here in the United States, we're on a progressive tax rate. So even if you're in the 24% tax bracket, you don't pay all of your income at 24%. You pay it progressively up to that 24% tax bracket. So the tax rate is important to me, because I want to understand, especially for business owners, how your tax planning is structured, what your tax professional is working on, because I want to make sure that any efforts that I make from a financial planning and investment strategy are complementary to your tax planning. Or if you're not doing any tax planning, well, then I want to talk to your tax professional, or I want to get you with a tax professional that I trust to start doing tax planning, so that way you're not overpaying what you should be paying, and that we're using the best strategies for your situation. And so sometimes I find mistakes simple things like a fat finger digit where, dividends are over-reported, as an example. Sometimes I see things on the tax return that I go, wow, that's a pretty cool strategy. I want to talk to your tax professional about that, because that's an interesting way to do that. Or I appreciate that you're depreciating this certain asset under this schedule. And so those are the kinds of things that I want to look for. But it becomes important, like I said, for owners, especially those who have flow-through entities. It can be very important for high-wage earners, especially once the kids are out of the house and you can't claim them anymore and things like that. So we just want to look at tax strategy, and the best way to do that is to get at the tax return and know what's happening there. Finally, the bottom row, this is your asset mix, or as I like to call it, your financial independence row. The first box that you're going to see is kind of like a yellowish orange box. It's called your liquid term, or your liquidity. And that's going to be all of your liquid assets. So think about bank cash, brokerage accounts, non-retirement accounts is what's going to be considered your liquid accounts. Sam and Sally currently have enough liquid assets, again, non-retirement accounts, to fund a little more than 6 months of their expenses. Now, if you look at the diagnostics of this, it's going to say that that's low. But for some situations, maybe they have more stable income, so we don't need to have as much cash sitting aside at one time. Maybe they're comfortable with having a little bit more risk, which means that they have a lower target cash reserve than some other people might have. And then they want to take the rest of the money and do something else with. So, what I mean by that is we might say, how many months of expenses do you want to have set aside? Typically, the good rule of thumb is 3 to 6 months of expenses. For some people, especially when you start talking about spending, 10, 11, 12, 13, even 7,000 per month, 3 to 6 months can be a lot of cash sitting in a bank account. And we may say, okay, it may not make sense for you to have 30, 40, $50,000 sitting in the bank account, or it may be really hard for you to save up to that amount of money just because of other things that are happening in life. So let's pick a number that's more comfortable, and that number for you could be 10,000 or 12,000 or 15,000 or 6,000 or 32,000. Whatever your number is, we're going to talk about how you're getting to that number, why that number is important to you, how close we are to hitting that number, strategies for hitting that number. But then once we hit the number, any dollar above that number needs to be put to work somewhere else. And so now we're developing another plan for that. And that's just basic cash management. We're going to look at, if you have cash that's sitting in the bank, is it getting the right rate of interest? Is it in a high yield savings account? Is it all in a checking account? Is it all in a savings account? Is it properly set in place to have the right FDIC insurance? All of that stuff, right? If it's in a non-retirement account, right? Because sometimes cash reserve can also live in an investment account and you can invest it. It doesn't have to sit in a savings account to truly be savings. But we want to make sure that has the liquidity. So if we're making investments in the market, can we get that money back in 2 days? And now that the settlement time frame is trade date plus 1 day for settlement, typically if we sell an investment today, we can have the money 2 days from now, and in your bank account probably on the third day. And so we want to make sure that we're managing cash well and that we've set the right cash reserve for you, and that we have a strategy for once we hit that cash reserve. And then, of course, if you hit the cash reserve and then you have to use it for an emergency, well, then we just re-engineer the plan to put the money back over time, or we move it from your investment account and then we start over, right? So there's a lot of flexibility there, but that's all financial planning stuff, right? Okay, next is going to be a lighter purple box. This is going to be qualified term. Think of this as retirement money. It's basically the value of your retirement account divided by your current spending, and those are on an annual basis. And so Sam and Sally, at their current spending and their current savings, have just enough to cover about 3 years of their expenses. Naturally, we want this number to be higher, and we want to see a mix of tax-deferred and tax-free or after-tax investments. So again, their income level puts them above the threshold for, or I should say the phase-out for the Roth IRA contribution. And so maybe we need to look at, do we put more money into their 401k? Because at this rate, neither of them are max contributing to their 401ks. So should we dial that up a little bit more? Or should we do some sort of backdoor Roth strategy where they're making a non-deductible IRA contribution that we then convert to a Roth IRA so they can start saving after-tax money, right? All of those things come into the conversation, and these are all cash flow questions. Because if we pull from cash flow to save for retirement, then we're taking resources from another place to put them in another bucket. And so we just need to make sure that we understand what that looks like as an impact. And so for them, maybe their best option is to increase the 401k contributions or the Roth strategy, or if it makes sense. And this is a topic I can probably do a whole nother podcast episode on, but I'm not going to do it today. But if it makes sense, maybe, just maybe, we look at what does it cost to get a cash value life insurance policy where we can build tax-free cash value over time. And again, do they need the insurance, and for what purpose? Because if we don't need the insurance and we're just buying insurance to save tax-free money, well, the problem is we're buying something and we're paying premiums, and all of that money is not going to you. It's paying for the cost of insurance and mortality rates and things like that. So we need to make sure we understand that, and we do that, again, smartly and with a strategy, and not just because it's another tax-free bucket. It doesn't always work out the best for everybody. So again, something to consider. One box over is a blue box. That's going to be your real estate term. And this is basically your real estate equity divided by your annual spending. Sam and Sally have enough real estate equity between their personal property, their home, and the building that Sally owns for her business, where her architecture firm is housed. There's enough equity there to cover about 4.5 years of their current expenses. Now, real estate values can be volatile. Real estate changes. You don't hold homes forever typically. Things really move around here. So, and also remember, part of this is business real estate, and so there's a lot of variation on what might happen with that property. So, the other thing is that real estate's illiquid, right? You can't tap the equity in real estate unless you either, number one, borrow against the equity, or number two, you sell the property. And so either one of those removes that asset from your balance sheet and gives you cash instead. So maybe the real estate equity will be used, maybe it won't, but it's a factor that we want to know because, again, real estate is an asset on the balance sheet. It's just not a very reliable one, and it's not one that we can easily get access to. Speaking of things that we can't easily get access to, business equity. And so based on the business equity that Sally has, and the way we come up with that is we run a valuation of what the business is worth. We subtract the debt for the business. We get a business value, and that's going to include real estate, cash flows, key employees, marketability, profit margins, and long-term EBITDA growth, and all of those things that you use to value a business. But the business is illiquid. But in her case, she can cover about 13.5 years of their current living expenses. So this business is a very, very valuable asset on their balance sheet. The trouble is, as I said, it's illiquid. And at the amount that the business is worth, it's about almost 72% of their total net worth is just this business alone. So it's a very important asset. If you go back to episode 44, I had a conversation with John Kiokio, and we had a conversation about planning for business exit or business monetization. And so that conversation will be very valuable for Sally and for Sam because so much of their net worth is tied up into this business. We want to make sure that it's captured the best possible way that it can be, so that way it doesn't just evaporate off their balance sheet. Because if that business goes away, there's approximately 2.3 million of their net worth is in that business. If it's gone, or if they lose that value or significantly get a discount on that value, now the rest of their life looks a lot different than it does now. And so we want to make sure that we do business planning very well, because anytime that you have 2/3 of your assets in any one category, and this can be, if you're not a business owner, the other place is you might have it in your personal real estate, or you might have it in your retirement accounts, especially for some older people who have been saving for 40 or 50 years of their career. They've got a lot of money that's saved up. And so when you have that much of your total assets, we want to make sure that we're doing careful planning to manage that asset group very well. We don't want to get it wrong, and we don't want to wait till it's too late. So the final box that you see is kind of like a limeish green color. Of all the colors, it's probably the closest to the Life Moves Wealth color, so I like it. But also, it's your when can I be done box. It's your when will I have financial independence and freedom box. And so for Sam and Sally, your total term is going to be all of your assets combined divided by your current spending. Their total term is 20. And so what that means is they have enough assets everywhere if they had to liquidate and could liquidate everything today for full value, not including taxes or inflation, that kind of thing. They have about 20 years worth of money to pay for their expenses, which is incredible. And so if you think about what that means, if they decide that they're going to retire at a traditional retirement age of, let's say, 65, that means that they have enough assets where they could potentially get into their 80s and still have money, because the assets will continue to grow. But if they just had to stop what they were doing and not invest anything else, they've got some flexibility. Now, if you're somebody who's looking at, at their age, they're almost 50, and they're like, we want to be done in 5 years. We want to sell the business. We want to stop working. We want to travel the world, whatever people want to do. Well, now you're saying, okay, if you do that at age 55, well, now you're going to get in well into your 70s and early 80s and still have enough money. So this number gives them a lot of flexibility. And in the Elements app that Life Moves Wealth clients have, they can actually go into this total term window, and they can move sliders around and come up with what's called their magic number. And so they can say, based on this period of time when I want to retire and what I want my total term score to be and how much money I currently have saved, they can slide that around and see how much money do they actually need to have their own financial independence. And so it gives us a lot of power and a lot of flexibility when we're using a system like that, because now we can have actually real conversations about retirement expectations, buying and selling assets, moving investment accounts, making life insurance decisions, all the things that we just discussed. We can do it in real time and with real implications based on where they are now. So I like it. I think it's a great system. Life Moves Wealth Management, we've been using it now for coming up on 3 years. And it's one of the best tools that I have found to help people understand everything about their financial life, even their investments. Now, clients of Life Moves Wealth have another app where they can go in and see their investment strategy, what their rates of return are, how it's invested, and all of that. But when we put it all together and make it all work together, now we don't just have the one-trick pony of investments. Now we have the entire financial life moving together, fully orchestrated or in concert, if you're a musician. It's all working together. It's all playing the same part. The sheet music is written beautifully. And we've got a great piece of music that's coming out of it. Now, that was just my analogy because I like it. And this is my podcast. I get to say things that I like. So that's what I'm doing here. But anyway, outside of that, I hope that this has been a helpful overview for financial planning. Now, there's people who are very much like Sam and Sally who don't have any of this put together. They don't have a plan in place. They've never talked to a financial advisor, or they have and they were turned off. I speak to people like this all the time. They had somebody, they paid them, they didn't get the results they wanted, they didn't get the contact they wanted, they didn't know what was going on. They fired the advisor, and now they won't go back to working with somebody. And then, unfortunately, they miss out on having the complete picture like this. And so I'm very biased. I am a big, big fan of, if you're going to work with any financial advisor, check their credentials. Find out what their experience is, get an understanding of their approach and their personality, who they like to work with, how their business is targeted for which types of clients, or it's built for which types of clients, and get a good match. Find somebody with the Certified Financial Planner designation. That one I think is still the hallmark of understanding that you have a professional who has a true fiduciary duty that has teeth. Meaning, there are some pretty severe punishments if we do a bad job and you file a complaint as the client. So there's some pretty hefty duties that we owe you as CFPs. And typically we're going to be the ones that are going to have the more complete understanding of where you are. We're going to do the most work for the best fee structure. A lot of us are moving to a fee-only basis, so we're not collecting commissions or things like that, or special payments from mutual funds. Many of us are moving to fixed fees for services, which means that we're setting an annual fee. We may not be charging an asset under management fee anymore. We may be consolidating those things. So there's a lot of different fee structures. You want to understand that when you're thinking about who to work with. But most importantly, I can't stress enough how vital it is for you and for anybody listening to this to have an understanding at any time of where they stand financially. Because again, as I said at the beginning of the podcast, every single decision that you're going to make in the next 24 hours is probably going to have a financial impact. Even the one of what time you should go to bed. Because the later you stay up, the more you're probably going to snack. And when you snack, you're going to have to spend money to replace those snacks. See what I did there? A financial implication. So that's it. I hope that's been helpful. Check the show notes. We'll have some additional detail in there for you and some resources for you to consider. By all means, if you've never had this exercise done for you, if you have no idea where you stand financially, head over to lifemoveswealth.com/our approach and click the Get My Financial Health scorecard button. You'll see it right there. It'll walk you through the steps to fill out enough information to be able to start to populate your scorecard. And then once you do that, I'll get a notification. We'll have a conversation about it. And then we can decide what makes sense for you from there for your planning needs and for what's happening in your financial life and whether or not we're a good fit for each other and what it costs. All that fun stuff we'll do together. But by all means, at least take the step. It's free. There's no obligation. Go to lifemoveswealth.com/our approach. Click that button. And the worst thing that happens is you know where you stand financially, and then you have an idea of what to do next. So that's it for now. I won't belabor the point or beat the dead horse or whatever other analogies you guys use out there in the real world. I'm done. Thank you so much for watching and listening to this episode. Go be financially awesome, and until next time, take care. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.